with IMS Associates. I am the life insurance and long-term care brokerage manager here at IMS Associates, and I wanted to start everybody off today by welcoming you and thanking you for ringing in with us today. I do appreciate you guys taking the time to reviewing our Universal Life with Long-Term Care Rider presentation. Excuse me here, just a little bit of a glitch, but we're back on board here. So we're going to be reviewing the Universal Life with LTC rider market. And before I get into that, for those of you who aren't as familiar with us, with IMS Associates, I want to give you a brief overview of who we are and what it is we're doing. So IMS Associates, we're a one-stop organization for annuities, DI, life insurance, long-term care, and life settlements. We're founded in 1986. We're currently active and licensed in all 50 states, but headquartered here in Orange County, California, and contract with over 40 of the industry's top carriers for the lines of business that I just mentioned above. Shifting gears here a bit, we'll get into then a little bit more onto the meat of what we're going to be looking at. But prior to really digging into too much of the riders, wanted to give those of you life guys out there who aren't familiar with long-term care just some brief kind of 101 definitions to make sure we're all on the same page as we continue to progress here. More details on the true meat of LTC and benefits and claims process. More than happy to review that with some of you guys after the call today. But long-term care overview, quick definition here for you. Type of care needed if you have a prolonged chronic illness, disability, cognitive impairment, or any limitation that prevents you from being able to do 2 out of the 6 activities of daily living, the so-called ADLs. So the activity of daily living, will be bathing, continence, dressing, eating, toileting, and transferring. Now, you see that in a variety of different ways, and I think some of them will even do per the order that you're most likely to need first. I like putting it in that format because that B, C, D, E, so, hey, kind of the alphabetized A, B, C, D, it makes it a little bit easier. We don't have an A there, but B, C, D, E, T, T is an easy way to remember this if you're out there speaking with your clients. A couple distinctions there to make, continence versus toileting per se. Continence is, bladder control, bowel movement control, versus toileting is the actual act of toileting. Transferring, that would be getting in and out of bed, in and out of the recliner or the kitchen table, et cetera. So actual physical assistance transferring. The rest from there I think are pretty self-explanatory. Real briefly on coverages included there, you're taking a look at the variety of forms of in-home and facility-based care, everywhere from, true home health care, homemaker services, adult day health care, assisted living facilities, nursing home care, respite, and hospice care, among others. Again, there's going to be some nuances you'll see on different definitions on a variety of kind of policies, and can go into some of those with anybody afterwards in the Q&A or any other follow-up phone calls or emails. But for today's sake, just going to keep it pretty straightforward at that definition. Cost-wise, whether you're talking hybrid or traditional LTC, really the cost is based on a combination of 2 set of factors. The first set being the monthly maximums available on the policy with the total pool of benefits available. That in coordination with the age and the health of your client or the age and the health of the insured is really what's going to dictate the pricing on this policy. A couple statistics here, just to kind of put a frame of reference on this for everybody in terms of why we're discussing this today. Isn't so much just because of the life-based portion of it, but it really is because of the relevance and need for some form of long-term care insurance. Nearly 75% of all people over the age of 65 will need long-term care at some point in their lives. So nearly 75%, that's, it's a little bit under 75. It's probably a little bit closer to 71, 72-ish, but nearly 3/4 of all clients you're speaking with are going to need long-term care at some point. The national average cost of care for a private room in a nursing home facility is $80,000. The national average cost of care for in-home care is going to be for $40,000 or $43,000. If we, for conversation, said we can just kind of split the difference on that and looked at about $60,000 a year, and you see maybe average claim experience anywhere from 2.5 to maybe 3 years, and just for even numbers, use 3 years, you can kind of real quickly see how relevant having some form of protection or some form of insurance against this cost can be, particularly if 3/4 out of all the clients you're talking to are going to need it. So if you're sitting down with a husband and wife, which in so many of these scenarios you are, statistically, 1 out of the 2 of them is going to use it absolutely. So that's very important. You kind of flip the tables on them a little bit, and not so much, hey, can you afford the premiums I'm suggesting today, but can you afford to not have some form of insurance? Can you afford $180,000 between the 2 of you, $360,000 today? and that's going to increase with inflation. It's been outpacing inflation. So, God knows what that's going to be when they go and claim 20, 30, 40 years down the road. Long-term care and some life statistics here, just overall to kind of put in perspective who we're really working with here. There are 7 million baby boomers out there. 10,000 baby boomers will retire today. They're going to have long-term care needs. They're going to have life insurance needs if they don't already have them. Another frame of reference here, these seniors, your clients in that age bracket, are 850 times more likely to need long-term care than they are to lose their home in the fire. But how many of those very same clients have some form of homeowner insurance with a fire provision in it? Or is there just a strictly fire-based policy? Nearly probably all of them, right? But not nearly as many of them are actually going to have long-term care, obviously. If you take a look down here before we change slide, this is real-life photos here, guys, of some of our agents' clients showing off their universal life with LTC rider policies, just to get anticipation up a little bit before we get into the meat of it here. Life-based LTCI solutions. So there's a variety of these out here now. We're going to be focusing on the first one that you've got listed there, level pay hybrid UL. This is a normal UL chassis available with an acceleration of the death benefit via an additional for-cost long-term care rider. This is really what we're going to be focusing on today. This is going to be, hey, you have your base benefit, and for an additional cost of insurance, you're going to be able to get a certain percentage of that death benefit available for your client every month, available for qualifying long-term care services. A few of the other products out there to kind of brush over them, single premium hybrid UL, very similar definitions, but typically done on a single premium basis with an ROP. Life insurance with living benefits, those are some of the linked benefits that have really gained popularity over the past couple years. And then the life policies, the ULs that have a chronic illness rider built into them. A couple caveats there on those two kind of policies are a lot of times those are discounted policies or discounted benefit amounts. Your client, let's say actually qualifies for $50,000 in a year for LTC, and they, request for claimed rehab accelerated $50,000 of the death benefit. Your client's not going to receive $50,000 in that scenario. They're going to receive a discounted rate based off of interest rates, mortalities, life expectancy, the amount of time left due on the policy to maturity, and the amount of premium they paid into it up to that point. So, that's going to vary a little bit on a case-to-case basis. No exact formula there, but those factors are used. That's just something to keep in mind here versus what we're speaking today, our dollar-for-dollar death benefit to LTC benefit-based policies. So you take a look here, guys, at comparisons. I'm not going to run through this whole table for a time's sake. I'm going to highlight our level pay-based products. That level pay-based product there, by definition, what we're looking at today is a chronic illness-based definition, needing care for 90 days or longer, with a severe cognitive impairment and or the inability to complete 2 out of the 6 ADLs. That is level, limited pay, and single premium-based policies. So remember, these are still flexible universal life policies. Level pay is really just a distinction to distinguish this policy from a couple of the policies out there that have a lot of popularity, Lincoln's MoneyGuard or Gemworth's TLC product, which are really truly, single premium-based products, and a little bit different, really function more off that single premium-based concept, which I can run it through with you after the call or in Q&A if you'd like. But these level pay policies, we will illustrate these with limited pay scenarios, and they look great. We do it on a regular basis. They look great on single premium and or 1035s. They really do. So if you have a client who's interested in doing a paid-up policy in that sense, don't just focus on the single premium-based structures. You can still look at these policies. They'll be a little bit more life-based than what you'd see on the single premium, but they still illustrate really well. Benefits there are really based off, for the most part, across the board with every carrier on a percentage of the death benefit, and that equates to what they're going to get for their monthly LTC benefit. Real quickly here, a quick example, at $100,000 of insurance, at 1%, hey, the mathematicians out there, that's going to give us $1,000 per month. At 4%, if you guys can get your calculators out, that's going to give us $4,000 of monthly long-term care a month. So that's an important note, and I'm going to touch on that a couple times here, as you guys will see throughout the presentation, as to there really being a significant difference between those two. The amount of long-term care your client gets today based off that percentage is the same amount of LTC they're going to have available to them per month 20, 30, 40 years down the road. Now, on these permanent-based life products, That's really important. You may not necessarily be selling it to somebody who's going on claim in 15, 20 years. This may be somebody who's not going on claim for 30 years. And with the cost of the inflation in the market, it's important to have a high monthly LTC benefit. Underwriting, these are fully underwritten products. We're doing exams and APSs, and they are screening for mortality and morbidity risk. No inflation is available on the riders that are available in the market today. Spoken with a few carriers who would like to maybe get that added and have to kind of kick the ball around a little bit on that. Haven't really got any real information as to that being the case in the future, but I think we're all kind of hopeful, and I would not be surprised in the next 24 months if we were to do this presentation that we had somebody doing inflation, but time will tell. The bottom line there, guys, or bottom row that we're looking at there on partnership, they want to make a couple distinctions here. It is true, yes, traditional long-term care is the only partnership qualified based policy. For those of you online who aren't as familiar with long-term care, what you're looking at with partnership is that is a essential dollar-to-dollar crediting for the qualification of Medicaid. Qualification for Medicaid requires a minimum amount of assets. So why that's useful is, let's say if your client has $250,000 in assets before they start their claim for long-term care, and they go through a long-term care policy that is also $250,000. Well, at the end of that process, if they had a partnership policy, they would be credited a full spend down of their assets for that $250,000 they had received in long-term care benefits, and they would be able to transition automatically onto Medicaid. If they did not have partnership, they spend $250,000 via long-term care policy and the benefit is exhausted, if they were to go to try to qualify for Medicaid, they would not qualify because they would not meet the minimum requirements because they still had $250,000 in assets. Minimum requirements are, vary state per state, but they are really pretty minimal. So it is nice to have that. That can be relevant, but an important point, I've always kind of discussed with this agents, and I've never been as big a proponent of partnership because the people you're selling to have money for the most part, and it's just very unlikely that they're going to exhaust their benefits to begin with. But even if they do, they're still going to have, some form of assets they're available to pay for long-term care that the spend down they had credited in their traditional LTC policy isn't going to be relevant. Now, I was speaking with one of our carriers who does partnership policies on this a few weeks ago, and this is one of the leading LTC carriers. We'll leave them unmentioned, but they brought up a very important statistic that really brought this to light. Of the 163,000 partnership policies they have sold, only 15 of those insureds have transferred to Medicaid. 15 out of 163,000. That's under 1,000th of a percent. So it's just not that relevant. All things being equal on a traditional LTC policy, if it's the same, we'll take it. I would take it if I was buying it and the options were the same, but one had partnership and one didn't. But I would not exclude another option solely based on that. And so these LTC riders, I guess point I'm making is they're still really relevant. Partnership in my book's just not as big as issue as maybe some people make it seem. Level pay you well with LTC riders. Quick kind of brief overview just to give you guys a heads up as we dive into some of this stuff. So we have an array of carriers offering this now, about 8 carriers, 8 of our brokerage carriers offering this on typically just their UL portfolios or specific UL products. But you're seeing that range on a portfolio basis anywhere from the no-lapse GUL products, current assumption-based products, index products, even have a carrier or two doing it on whole life, as well as on variable life. And these riders are offered as tax-qualified 7702B plans. A little bit of a distinction between that and some of the other riders you've seen on the chronic illness. That's something more detail-oriented. Be more than happy to go through with anybody in the Q&A or in a phone call after the webinar. As I've mentioned, 8 carriers we're working with here at IMS with the true UL or even the whole life LTC rider-based platform that we have here. Highlighted a few of them here, guys. Don't have time to get through everybody here, but you can take a note if there's some carriers you like riding with on a regular basis that are listed there. I'm going to start with Genworth. They're new to the game on the LTC rider, but obviously they're not new to long-term care, one of the leaders in the industry. And really excited they've hopped into this market with a really pretty good rider. It is available on their IUL, which is their index product. They're only issuing it through age 65 and through standard. That's kind of a LTC carrier's perspective on this and mentality. So you can definitely see that carry through to the way they built this. And they're doing a 1%, 2%, and a 4%. They break that down versus, the months divided into the amount of months you can accelerate into the total death benefit there. But not to get into that, really what you're dealing with is a 1%, 2%, and a 4% acceleration on a reimbursement model. So I'll stop right there for a second, just for those of you out there who aren't familiar with reimbursement versus the other style of payment